Well, 2021 has been an absolute cracker of a year for real estate and property in Australia. Um, Most markets have experienced double-digit growth. Some markets that's been quite crazy growth. Um, I'm based here in Brisbane, and in Queensland, we've had growth in the range of about 26 to 28% over the last 12 months. Some of our other markets around Australia also have experienced significant growth. It hasn't, and there's been a lot of discussion in the media and with experts about when that growth is going to taper down, but the growth hasn't shown any abating at this stage. So 2021, if you owned property or you invested in property, it was a great year for you. In Queensland, particularly, one of the things that we've experienced is the southern states of Sydney, Melbourne, they're not the states, but the cities of Sydney and Melbourne, they've had growth for a couple of years now. And we've seen that growth continue, even though, market pundits have said maybe it's going to taper off. One of the things we're experiencing in Queensland is we haven't had that massive growth or the significant upswings that those southern states had. It's only been this year that that market growth has started to come in. So, we're just catching up in Brisbane, I guess, the southeast Queensland corner. We're only just now catching up with some of the growth that's been quite steady and stagnant over the last 10 years. The last upswing we had here in Queensland was probably 2010, 2011, after the GFC was settling down. So yeah, it's been a great year to own property, and if you're investing in property, it was also a great year to get those capital gains. If prices are going up, that's great for the people that already own property. It's great also because there's a large proportion of the population that are looking at downsizing as well. So we've got the baby boomers that are retiring, maybe thinking about getting out of their family homes where they raised their families and lived in for many years and looking at downsizing into an apartment or into a retirement village type of living. But the increase in price also comes at the disadvantage of those that aren't in the market. So I do feel for first home buyers or those that have spent, a long period of time trying to save up for a deposit. And you do, based on, the Royal Commission and all the changes in the banking and financial regulation sector, you really do need to have a deposit to get into the market these days. And that's taking a lot longer for people to save up. So it's a real challenge for that sector of the market. It's also been a challenge because the Australian government and many of the state governments also looked at the construction and the building sector as a way to stimulate the economy. So there's quite a lot of economic packages to stimulate the economy, but that's probably contributed to some of the increasing demand issues that we're currently experiencing, and also contributing to the significant challenge of getting a builder or any sort of labourer to do work in this construction sector at the moment. I think the top tiered markets, the Sydney, the Melbourne, they may come off the boil a little bit. What we will probably see is the second tier locations starting to come to the fore. And that's because people are getting priced out of those southern markets. It's really expensive. When you're looking at, in Sydney particularly, if you're looking at a 1-2 bedroom apartment in Sydney, that's $1 million entry level, that's a significant cost. And as an investor, you're going to be really needing to chase the yield to get the return on that investment. So I think what we're going to see is the regional or the sub-regional areas starting to become more popular, particularly lifestyle orientated markets. So anything that is within commutable distance to major CBDs or on the fringe of commutable distance, they will start to see the next upswing. We will still continue in Southeast Queensland. I think there's a good 12, 18 months left in this current cycle. And then those other periphery towns will start to also experience the upswing. Got to look at the way that we're living. We're not so much seeing housing or the home anymore as just a place that we go to eat and sleep. We're doing a lot more of our recreation there, and as a consequence, we need to have those lifestyle amenity there. And people are wanting a little bit of space, so that's going to be a challenge for local councils, particularly in planning for housing growth. A lot of areas are quite constrained with available land, and the cost of that land is really increased substantially with infrastructure charges and costs associated with it as well. So it's a real situation that we're facing at the moment. I'll deal with the separate housing first. I think with the separate housing, what we're definitely experiencing, people are seeking out green space. So not necessarily within the block, there's still this mansion or a large house with a smaller outdoor recreation area, but within close proximity to a park area or place that they can do their walk and run, that type of thing. It depends on which sort of market segment you're talking about. For probably the last 10, 15 years, most apartments that have been built in Australia, and I use broad brush Australia, have been investor stock, so 1 and 2 bedroom apartments. I think that market segment's fairly well saturated. I think what we're seeing for the future is that if you want to attract an owner-occupier market, they are seeking out bigger apartments, especially families. It seems to be more acceptable these days that families are choosing that as a lifestyle choice over the separate dwelling. Although, having said that, most families still want a single dwelling house to live in. In terms of apartments, it's a really interesting thing. COVID's taught people to be fearful of others. And when you're living in a confined space with others, then that leads to certain social tensions. So I think we will experience some growing pains for some time in the apartment space around how willing people are to accept the other type of person that lives with them. And there isn't a lot of guidance from governments either about the health regulations, what's actually important for bodies corporates and owners corporations to deal with in terms of COVID. And a lot of body corporate managers are having to implement their own sort of regulations and guidelines for bodies corporates and owners corporations about how to deal with this type of thing. I think the government needs to take a stronger step there to assist them, remembering that bodies corporate are representative of the lot owners. They are the lot owners, and those lot owners are voluntary organisations to manage and maintain those buildings. So they might not necessarily have the skills and resources to make some of these decisions. Unfortunately, some of the regional cities are going to experience some decline. As we speak, Townsville, one of them, it's really struggling. Some of the areas around Cairns also having some real struggles in terms of that. The mining towns, it's always a double-edged sword with the mining towns. When the market price of coal or whatever they're mining is up, it tends to be okay. And there's this, that there could be challenges though around the infrastructure created in those towns, and particularly with a lot of mines creating their own little villages So I'd still be very cautious of the mining-centric towns. But if you think about it, agricultural prices are also up. Everyone, cattle prices are up. So that's driving some wealth through those regional communities at the moment. So the Australian borders have been shut, and that's created a lot of economic, uncertainty and a lot of economic challenges for a lot of people. But it has also created this opportunity for people to stay within Australia, travel within Australia and see more of Australia. Unfortunately, for most people, interest rates will be going up. Probably more towards the end of 2022 or in the mid-range, mainly because of situations with the CPI and the fact that it has been at historic lows for such a long period of time. I think the RBA is going to be concerned about the property prices and the growth in the property prices and how that's flowing through to the rest of the economy. So yes, unfortunately, for those people that have overextended themselves to get into the market, this may be bad news. But the interest rates were never going to be staying at those low rates for ever. And it's as a property investor, it's about how you structure your deal as well. So obviously, people need to look at some of those aspects of the way they're purchasing the property, how they're buying that property in, and what type of structure they're buying it in, and then what that means for financing. It wasn't that long ago, 8 to 10 years ago, property interest rates were around 7%. And now they've been historically low for the last 5 years at least. They've been trending down and been quite low. So if people have been paying off those interest rates or have been, saving up for the situation where they may have put aside emergency funds, they're going to be okay. But it's the people that have really entered into the market quite late, paid high prices, and really extended themselves to purchase it. Potentially we'll see more of that mortgage stress starting to come into the marketplace. But Australia is quite different from some other markets around the world in the sense that if those that are experiencing mortgage stress, it's not necessarily public knowledge that a property is entering the market because it's under mortgagee in possession. There's covers for that, and that's quite helpful in the sense of it won't have a significant impact upon the market. Financial institutions as well are not going to release a large portion of their mortgage distressed properties into the market, so that's also not going to have a negative effect on property prices. That would be totally against what they are set up to achieve in terms of their goals. The markets that aren't traditionally auction markets, so that would be Queensland and WA, they're not traditionally auction markets. What we'll see is more growth in those markets. So more people are comfortable taking those properties to auction. In this type of market where prices are just going crazy, it's obviously advantageous to take it to auction because you just don't know where the market's going to actually rest. The Sydney and Melbourne markets will probably maintain some sort of strength of their auction market in the sense that they will have significant clearance rates still, but we won't see significant price growth in those markets. Adelaide's a different market again. So, it just really depends on who's buying into which markets. What we'll see, I think, in Sydney and Melbourne, to a lesser extent, but Southeast Queensland as well, is the international market starting to, when the borders open, we will see the international buyers coming back in. Also in Perth. I mean, obviously Perth's got the very UK focused or the European focused market. A lot of the international markets are looking at Australia as firstly a safe place because it's a very transparent property market, very safe property market. But secondly, there's an opportunity for certain demographics to park their cash here in Australia and be comfortable with that. But they're also, we are considered a safe destination in terms of how we've responded to the health pandemic as well. So there is a lot of people that are looking to Australia as an area that they'd like to invest in coming years, but maybe not sophisticated investors in the sense of they want to come and see and actually experience before they commit their cash to Australia. I think it'll be a combination of rental investments as well as people seeking to immigrate to Australia. It's really been interesting over COVID watching how the property market has responded. The first wave has been, people getting into the market because they're not travelling as much. The second wave, and those that are coming back from their international destinations to relocate back into Australia, that traditionally Australian residents that have been offshore. The second wave has been the upgraders, so people that are, looking to upgrade their lifestyle and get into a slightly bigger house. Their house isn't fit for purpose anymore, so we've seen that wave. The next wave will be the international market. I don't know whether it will be purely investment market though, because a lot of the foreign investors may be quite happy to sit with a house that is not necessarily invested, like rented. Some will, obviously. The international student market's going to be challenging, and this is really confronting. Obviously, I work within a university, so international students are, the bread and butter of most universities around Australia, and we're very keen to have them come back. But the opening up of international education, higher education market, I think that having the borders shut has been a real disservice to our international students, and a lot of other countries have been more welcoming of those international students. So international students is going to take a long time to come back to Australia, and so that's more of a long-term issue. I think if we can capitalise here in Australia on highlighting how we have responded to the pandemic, safety and security, number one, and transparency of the financial institutions and security of investments would be the number two things that I would do to market to that international demographic. It's going to take some time. It's unfortunate that I say that, because I know that there's a lot of mum and dad investors out there that have purchased in to buy their first investment property as a 1 or 2 bedroom apartment, because it's entry level, it's cheap, it's affordable, but because there's so much stock of it as well, then that's going to make that market quite flat for quite some time. Developers see this, and that's why they're not building as much of that type of stock. And so as a property investor, you probably should be looking to where are the developers investing, or what are they creating, because that's where they see the future market. So I think that's something that tip for the wise. Well, I mean, I really feel for the people that have been in Melbourne, particularly. Sydney, of course, as well, but Melbourne, they've been in lockdown for so long. And so you obviously do feel for them. And there is a lot of those southern buyers that have purchased up in Queensland, particularly. Queensland has very much benefited from this, from those people for the interstate migration. Interestingly, the Sydney and Melbourne markets are the ones that traditionally have gotten people to go there for work purposes, and also the international student market's very strong in those two cities. They're obviously getting affected because of the international student numbers. So Queensland and WA have had very strict border controls, which has been great for our COVID response and the numbers there, but it has had an effect on property prices, more so in Perth, in WA than in Queensland. I think one of the challenges is Perth's a significant flight away from the rest of Australia. So it's its own little area on the other side of Australia, which probably gets forgotten by the rest of the property investors over here. So I know that with that market, it's got different drivers behind the property investment market. Remembering we've also got South Australia in the middle as well, and they're seeing an upswing in investment as well. So it'll be interesting when the international borders open and how that will have a flow-on effect to demand, probably in Perth, Adelaide and Brisbane. I think with the Sydney and Melbourne markets, we're probably there at their peak and probably about to go down. It's interesting when we talk about these different drivers behind the markets, because Canberra obviously has got the whole government and powers of government behind some of the driving forces there. As we see more people respond to working from home or working remotely, working anywhere, however the term is that people put on it, what we're seeing is changes in how people respond to where they're choosing to live. Previously, for example, we'd have a lot of people that would live on the Gold Coast and commute to Sydney, Canberra during the week. We're finding that they're commuting, obviously, because of the border closures, that sort of stopped. But even when the borders were open, less commuting and more doing work remotely. So it depends very much on the flexibility of our large organisations, the institutions, to see how they respond to people's desire to work remotely and how they make it work effectively for organisational culture. So it's really interesting, isn't it, that, you know, the property market isn't about just simple economics of supply and demand. It really is influenced by society, what's shaping topics in society, how people want to live, their desires of where they want to live, and how they can make that work for them. So I think even more, taking some of the raw hard numbers out, people as investors, property investors, in the next couple of years, what they're going to have to do is look more than just at number crunching. They're really going to have to look at societal impact and what that will mean for property prices. Obviously, major announcements as well. So we've had the Olympics announced for Southeast Queensland, or for Queensland more broadly, for 2032. There's going to be a need for significant investment in infrastructure to facilitate that, considering our cities are growing and we need to be able to move people around those cities effectively. But that will have an influence on property prices as labour is required to develop that infrastructure. It's going to take many years to do, and we will see some shifts in where that money will go. So that's going to be interesting to see in the next 10 years. And you think about property investors, the vast majority of property investors, probably 80% or more, would only have one additional property beyond their principal place of residence. So we're talking about a large pool of relatively unsophisticated investors in that sense. Mum and dad, everyday Australians. That's the type of investor we're talking about in the property sector. If you compare it to what growth has occurred in the ASX, for example, or in international markets, financial markets, even in digital markets, what we'll see is that people may look at the cost of owning property and the return on that investment. And they might not see it as potentially being as worthwhile. So they may look to diversify where they're investing and not have it all in property. They may look to have it in property as well as shares, as well as other forms of investment, which is a great thing, because diversity is obviously one way that you can spread the risks. But it's not necessarily a great thing for Australia, because Australia needs housing. And we don't have enough housing currently to fill the needs that we do have. So we do need to invest in housing stock. What's really interesting is that the governments, and I talk about all governments here, federal as well as state governments, are really doing a disservice to the property sector because they're not, they see property or housing as a free independent market. They don't necessarily see it as a societal issue and the effect that having safe, secure housing will mean for society more broadly. So there is a lot of investment required, particularly at the social and affordable housing sector. And maybe some of that 1 and 2 bedroom stock apartment could be adapted to address some of those needs. But to do that, we need to look at how we're funding the social and affordable housing, how we make that more attractive to the broader property market, particularly, would be something that we need to look at. It's a big issue. Getting anything timber related at the moment is so challenging. Getting consistency of that supply chain is particularly a challenge. We've obviously sent a lot of our manufacturing offshore. Maybe we might need to look at how we are manufacturing goods and services and bring some of that back within the Australian context as a risk mitigation strategy to deal with some of these issues around supply. One of the challenges also being because of the increase in demand for a lot of these products is that the prices have increased substantially. 30% increases in concrete, 30% increases in other aspects that go into the production of housing add significantly to the bottom line of manufacturing. So that has to be passed on. So how is that passed on? It may be passed on through obviously increasing cost of the house itself, but it could be looking at ways to reduce the cost of the house. So that may lead to potential issues with housing defects in the next probably 12 months to up to 5 years. And in some states that could be up to 10 years because building defect regimes are different in the different states. But when there is a lot of demand for labour within the construction section, the construction sector, what we often find is that has some impact upon the quality of the built form that we're creating. And unfortunately, over the last 15 years, you don't have to look very far to find where those building defects have occurred. And particularly, a lot of those have been, unfortunately, well publicised in the media in the apartment market sector. It's not necessarily that it's experiencing more defects, it just seems to be more publicised, the defects.
Sure.
Of course, it's affecting a greater proportion at the one point in time. Obviously, when you're building a high-rise tower and you're having the building crack and shift and move, the risk is significant and it's going to have flow-on significance to the people that live within them. Unfortunately, off-the-plan apartment sales contracts have predominantly been drawn up by developers' lawyers. They're very biased towards the developer, as you know, you would expect them to be, because the lawyer is operating on behalf of the developer, and the developer is ensuring that they get a return on their investment. However, there is no consumer protection for purchasers of off-the-plan apartment sales contracts. People are also marketed a lifestyle. They're marketed the dream, and that's what that emotional pull toward for the person that's purchasing an off-the-plan apartment sales contract is often clouds some potential judgment that they have about actually seeking qualified independent legal advice. Unfortunately, cut price conveyancing is also muddying the water, because generally people think, oh, you only need to pay $1,000 to get your conveyancing done. But that's just surface level. They're not going to read a 480-page off-the-plan apartment sales contract. That cost would probably be $4,000 from a lawyer to actually go through. And once the lawyer pointed out all the problems in that contract, then, you know, it could scare the purchaser. So obviously there's all these sort of things that factor into it. Very important to get independent legal advice and make sure you know what the legal advice is actually going to cover. So these off-the-plan apartment sales contracts can be anything from 10 pages to the biggest one I've seen is about 630 pages long. So, you know, that's a lot. So get independent legal advice first thing. Second thing to do is understand what you're buying. And I don't think a lot of people understand when they're buying an apartment, they're buying into a body corporate, which has the right to obviously occupy that property, but also a right to manage and maintain that property. So they've got to voluntarily contribute to the management and maintenance of that building. I don't think people quite get that. They think that the body corporate manager does that, but no, it's the body corporate that does that. The manager just really enacts what the body corporate decision making is. If no one's actually looking at the fees and contracts, some of their contracts might not necessarily be worth what they're paying. So that conflict, there's a lot of conflict of interest around it. The other thing I'd suggest you do is on settlement, get an independent building certifier or an independent qualified building person to do an inspection of the property. Look, a lot of times the contracts are so heavily weighted that doesn't happen. The settlement occurs as a financial settlement, not necessarily a walkthrough. In most states, you've got probably 12 months to do for the developer and builder to come back to do aesthetic repairs, but it's not that's the problem. Sometimes it is a problem, but it's the latent defects, the stuff behind the walls that you can't see. Is the fireproofing done to the code? You know, is the key issue with most apartments is waterproofing. Waterproofing is such a problem. And probably 80% of buildings in Australia have issues with waterproofing. It's a widespread issue. And New Zealand suffered something similar 20 years ago, and they've been progressively addressing it. But in Australia, we haven't addressed it yet. So we need to look at the building defects, what's occurring, and ensure that the developer or builder is held accountable and comes back and actually rectifies the problem. Because if they don't, it's the body corporate's responsibility to rectify the defects, which means it's the property investor that bought into that property. I would always seek independent advice. And that's a challenge with certifiers as well. You know, who is paying the bill?
Yeah.
And if it's a developer that's paying the bill or the builder that's paying the bill, then you are beholden to the ethics, I guess, of that contractor, that they're going to do the right thing by the consumer, when that's not necessarily the case, because they have a relationship with the builder and they want to get more business from them, so they'll continue to do a good job for them. So they're not necessarily going to get repeat business from the mum and dad property investor. It depends on what your goal is for that property. So if your owner-occupier residents will generally be ensuring that the building is maintained to a certain quality standard, whereas high levels of investor owners may be just looking at the return on their investment, the rent coming in to be able to cover the expenses going out, which is fine, but that means that oftentimes they won't do as much maintenance, because then that reduces how much the fees are. So they might be pushing back on the body corporate budgets so that they don't have to pay as high expenses going out. So that's where it would come to the fore. It's generally, you know, it depends very much upon the scheme and how it's set up and the people within it as well. Absolutely essential. You need to know who the builder is, who the developer is, what their previous product is, what type of problems that they may have. So in each of the states and territory, the building commissions or the equivalents would be able to, you could do a license search to ensure that license to do the type of product that they're actually building. I've seen situations where the license is to cover tiling, but the builder is building a 4-story apartment complex. So you need to ensure that you've done your own due diligence around the quality of the contractors that are being supplying the product.